Welcome back to Business 110. This module contains two chapters, Chapter 17 on accounting and Chapter 18 on finance. So we're going to go relatively quickly because, again, this doesn't replace reading the book. These are just short 5-minute summary videos. So what accounting really is how you keep score financially. So in any sporting event, you have a scoreboard. Most businesses have a scoreboard, how well they're doing. There's two things you keep track of. One is external reporting, where you're reporting to the world, and those come with lots of rules, very little flexibility because somebody might want to invest in your business, so you can't be misleading. So there's what's called GAAP, or generally accepted accounting principles, rules and strict rules on what needs to be reported and how it needs to be reported. So that's financial accounting. Then there's a thing called managerial accounting, which tracks how internally how I'm doing. How are my managers doing? How's each manager doing to their budget? Lots of flexibility on how I do things managerially, because that's internal to my company. Financial, external, not very flexible. Managerial, internal, very flexible. Auditors will come and check your books. Auditors can be internal or external. They just verify that you're conforming to generally accepted accounting principles. Taxes, there's tax accounting, there's government and nonprofit accounting, all sorts of different accounting. A couple key equations for you to remember. Assets are what I own, minus liabilities, what I owe, equals what I'm worth, my net worth. Sometimes pure accounting writes it as assets equals liabilities plus net worth. I've just done some algebra. Assets, what you own, minus liabilities, what you own, equals your net worth. Three key financial statements in accounting. Number one is a balance sheet. It just basically calculates how much you're worth. The second statement is what's called an income statement. That's sort of like how much revenue did I take in for the period, less all my costs, including taxes, will tell me how much money I made in that month. The last statement tells me if cash is coming in or going out of my business. So it adds up all the cash that you get and subtracts out all the cash that went out of the business. And it breaks it down into three key areas. Cash that you get from operations, basically running the firm. Cash you get from investments, that could be selling assets to gain cash, or cash that you get from financing, either borrowing money or selling portions of your business via stock purchases, part ownership. There is some analysis that you can do on financial statements. They're called ratios. First, you might want to see how liquid your company is. So you might compare your current assets to your current liabilities. You might want to see how deep you are in debt, so you would compare your debt to how much worth you have. And the reason for these ratios is, if I had $1,000 of debt, but I'm worth $10 billion, well, then it's not a big deal. But if I have $10,000 of debt and I only have $5,000 of net worth, now that $10,000 of debt is a pretty big deal. Ratios. Remember the key three financial statements, and remember the different types of accounting. The next item is finance. So what is a financial management? What do financial managers do? Well, they basically operate all of the financial details. And lots of times they'll do what's called financial planning. They'll do some long-term planning, some short-term planning to establish goals. What are some of the things they're looking for that they need to do? Well, they need to manage the cash from the day-to-day basis, do any short-term or long-term financing, because cash running out is something that'll make a business go bankrupt very, very quickly. So financial managers deal with all sorts of stuff, including all of the financial and accounting issues, and a lot of it is a planning function and a controlling function. Any questions? Let me know. Have a great week.